Fixed income. Wow, to say this has been an interesting asset class is an understatement. We've just gone through, well, the biggest recorded drawdown in history for this asset class on the back of a very strong tightening by central banks and also credit widening due to economic uncertainty. So it'll be really interesting to hear what the silver lining is and how portfolios can benefit from that. And to lead that discussion will be Adam Bowe from PIMCO.
Thank you very much. Now let me just see if I can get this slide back going. Perfect. So it's fantastic. Thank you for the opportunity to come to speak today. It's been many years of navigating an income desert with clients. It's great to be invited back to our speaking panels again to talk about the wealth of opportunities in the bond market that the volatility of the first half has created. I've been doing this for managing bond portfolios for over 20 years, and I'll also say it's the first time I've got up after an equity panel and listened to an equity panelist say there's value in Australian government bonds. So it's a very unique moment in the history of financial markets that we're in. You're welcome. Okay, so we've titled the presentation today "Saying Goodbye to Tina." You know, we've gone through a long period of repressed yields, repressed volatility, over-exuberant central banks. They've driven many investors into risky assets under the excuse of there's no alternative. And through the volatility of the first half, that period of time is now gone. There's now opened up a wealth of opportunities and alternatives for investors, and a lot of attractive opportunities in the global bond market that I'll walk through. So I just wanted to start with a little bit of what just happened. What drove it, how did we get here, and more importantly, where we think we're going for the global fixed income market. This chart hasn't come up too well, so let me describe it to you. The chart on the left is meant to have an array of other returns in the global bond market, the maroon one being the current year, unless it comes up now. So the point is we've just come through the worst first half of the global fixed income market since indices began. I've used the US Global Aggregate Index starting in 1970. It's got a longer history than 1977. It's got a longer history than the Aussie bond one. A little bit about halfway through June, we were 3 times the worst other drawdown in the first half of a calendar year. We've finished at about 2 times the worst. And you can see the big driver is the chart on the right, which is interest rates. This is nothing new. I know you're familiar with this, but it's important as fixed income investors to step back and just be aware of that. This big drawdown we've experienced is a little different to other experience of drawdowns that have been driven by permanent capital loss, credit impairments. This has been an interest rate normalisation to more normal levels that have driven that. So a very different period and certainly not a permanent credit impairment or capital loss. So that's a really important point. And it hasn't just been the global bond market. As you can see on the chart here on the top right, global equity markets are down 20%. Bonds drew down about 10%. Credit spreads wide, and there's very few places to hide, in global financial markets in the first half of this year. And what was driving that was this rapid response by central banks to very elevated, sticky, and unanticipated inflation. And you can see how challenging this has been for particularly households and will continue to be. The chart on the left is US inflation again. We have a rich data set, so we often use it. So high single digits inflation, some parts of the developed world like the UK in the low double digits. It's been a long time since the early 80s since the world's experienced this level of inflation. And you can see the yellow shaded bit is all the essentials that make that up: food, energy, and shelter prices. So it's unavoidable inflation for households, which is making this so challenging. So this combination of rapidly rising interest rates, lower asset prices like equities, wider credit spreads, and elevated commodity prices has driven a very rapid tightening in financial conditions. So this is the US, this is a PIMCO's US Financial Condition Index. So a higher level of the index means more challenging, tighter financial conditions, and a lower level means easier conditions. We've just come through a period of very easy conditions with interest rates at zero around the world and inflated asset prices. So, a couple of things jump out at this. So financial condition index just combined interest rates, currencies, credit spreads, commodity prices like oil, petrol, those things, to see how tight conditions are for businesses and consumers. So you've seen the rapid rise, but importantly, if you go back to the last time it peaked in 2018, that was the peak of the last Fed hiking cycle. So in terms of conditions that we've seen now, already much tighter than the peak of the last Fed hiking cycle. Obviously in Australia we haven't gone through a hiking cycle for 10 years, but you have to remember the US did and peaked interest rates back in 2018. So a very rapid rise. And financial markets have done a lot of the heavy lifting for central banks as a result. Financial conditions already very tight. So that's the bad news. So that's where we are and how we got here. The good news is looking forward. As I said, the financial markets have done a lot of the heavy lifting for central banks around the world, and I think the adjustment higher is allowing, particularly the global bond market, and I'll make some comparisons and relative value comparisons to other asset classes around the world, but certainly opened up the possibility for bonds to play their more traditional role in portfolios. So let's start by just refreshing what that is. Why do we hold bonds in portfolios? There's three key reasons that we hold bonds in portfolios. It's income, it's diversification for the riskier parts of your portfolios, and it's capital preservation. From extremely low levels of interest rates, all three of those are very difficult to do. With an adjustment higher in interest rates, all three of those, the prospects for bonds performing a more traditional role is a lot stronger. So let me just step through each one of those and sort of clarify why that is, and look at the opportunity set that's opened up. So starting with income, all I've done here is just chart a history of some of the historical yields relative to central bank inflation targets. Can't really see it, hasn't jumped out really well, but here the 1 to 3%, I've put just a typical central bank inflation target. Some of them target 2%, some 2 to 3, some 1 to 3. But you can see, for the first time in many years, high quality bond portfolios now offering yields comfortably above long-term central bank inflation objectives. So you got core bonds, 4 or 5%, and more credit-focused bond funds up 6 to 8%. So certainly after a really challenging period of searching for yield and searching for income for investors, the adjustment higher in interest rates and some of that's been a widening in credit spreads has really opened up that opportunity set. And these are high quality daily liquid mutual funds. This isn't sort of lock-up vehicles or anything like that. If I plotted those, they would be much higher. So these are high quality daily liquid mutual funds. So the starting point of yields and carry and income is really attractive relative to history and relative to central bank inflation targets. Obviously that's an important assumption, assuming inflation can come back to those levels, and I'll talk to that in a couple of slides. And it's not just the absolute value of yield available in the global bond market, relative to other opportunities, it's very attractive. Here we've just plotted a sample of Australian corporate entities everyone would be familiar with. And we've just got their bond yield and their equity yield. So comparing the same entity, how much cash flow is going to bond investors, how much cash flow is going in dividend yield to equity investors. And you can see this doesn't include franking credits, which is different for every investor. So that changes the level of the bars slightly, but the thematic and relative to history is very consistent. So looking at the same entities, investing higher up the capital structure in an unsecured bond relative to equities is giving you comparable, sometimes better income outcomes, income objectives. So you can see the solid bars, I've just got dividend yields, and the hashed bars of the same colour are the bond yields. So higher up the capital structure, it's been a long time since we could put a chart up like that for investors as well. Important question, once we look at the income opportunities, another really important reason why investors use bonds is the diversification benefits in their broader portfolios. So the expectation that as riskier parts like equities of the portfolio perform poorly, bond portfolios do well. And it's a really good question because it certainly isn't what we experienced in the first half of this year. So historically, that low or negative correlation tends to work. In moments of reasonable drawdowns or recessions in global economies, you get some protection and capital preservation from your bond portfolio. So the question going forward is, do bonds still provide that? And I think for me, the question comes down to, once again, that inflation question and inflation expectations. So what I've got here, looking at this correlation, is the chart on the left here just charts the correlation, if it's positive or negative, relative to long-term inflation. And you can see if inflation remain anchored around that 2% objective of central banks, bonds typically provide that low or negative correlation to broader asset markets. It's once you move right on the chart and at a sustained high levels of inflation, that starts to break down, which is, makes sense. So the question is, do we expect inflation expectations to remain anchored and inflation to come back down towards central bank targets? It's certainly PIMCO's view. But it's supported by long-term observations. When you look at the inflation expectations embedded into financial markets, that's the chart on the top right, you can see despite really high levels of current inflation priced into bond markets in terms of break-even rates of inflation in bonds is sort of in the mid-twos, pretty close to central bank targets. That's a 10-year inflation expectation out of the bond market. And when you move outside of financial markets and you have a look at business surveys, household surveys, what's your longer term? Here we've got a US household survey of a 5 to 10-year inflation expectation. It's risen a little bit. It's come back with the aggressive rise in interest rates from central banks. But that's still hovering around long-term targets. I think that's the key. And for me, every sort of 50, 75, 100 basis point hike in interest rates from central banks around the world, the risk that we lose control of inflation recedes quite rapidly, and the risk that we're moving into a recessionary environment rises pretty rapidly. So that's the correlation. And then the reset in values has the drawdown in prices has improved our expectations of returns across asset classes that have experienced that. So we've just, every 6 months, we recut our capital market forecasts and assumptions. So for interest rates, currencies, bond returns, equity returns. And here we've got the last couple of 6-month times that we've done it. So the green is the most recent observation from June from our forecasts. So this comes from a 100% bond portfolio to a 100% equity portfolio, and I boxed the 60-40 because that's what everyone tends to look at when they're thinking of diversification benefits for bonds. So we certainly think the bonds at these interest rate levels provide that diversification, and we think that prospective 5-year average returns are now closer to 6% for a typical 60-40. So that is pretty close to its long-term average. Now that we've come so far back in interest rates and equity prices. Last point I will talk to before I conclude is around capital preservation. And I came in a little earlier. I was listening to the panel that we just discussed around this extent of interest rates pricing and central bank cash rate rises that's already priced into bond markets, and commented that that might be over exuberant on bond prices or interest rates in financial markets. So let's have a look at, because the question is very legitimate. The question is, we've just had a 10% drawdown. Interest rates have gone up, above 3% across the yield curve. Why can't they go up to 4%, 5%, 6%? Where that capital preservation piece will break down. So here's what's priced into financial markets. This isn't a PIMCO forecast. This is what's priced into global bond markets at the moment. So the green line's the RBA, blue line's the Federal Reserve. The dashed lines down the bottom is where we were in Christmas, and since we've had a rapid rise. So if you have a look, financial markets expecting both countries to have policy rates or the cash rate up around 4% by early next year, 3.5% to 4%. before the possibility and potential of an easing cycle starting in the back half of 2023, given how restrictive that will be. So that's what's priced in at the moment. And it's important I start there when I talk about capital preservation, because you have to get cash rates beyond that to lose money in bond portfolios due to interest rates. And so, you know, we've got an RBA meeting this afternoon. We expect them to hike by 50 basis points. Don't worry, if you're holding bonds, it doesn't do anything. It's already priced. RBA have to get rates to 4% or higher by early next year for the RBA and interest rates due to cash rate rises to start causing negative returns in bond portfolios. So it's a pretty high hurdle. We think it's really unlikely. It's going to be challenging that central banks like the RBA can hike beyond that. And I'll step through why that is. Whenever we think of, you know, the limits of central bank policy, you have to look at the fragile balance sheets in an economy. So when you look at places like Europe, it's probably peripheral sovereigns, which is why the ECB, the European Central Bank, is setting up support mechanisms for European peripheral sovereigns while they hike interest rates. In the US, it's not households. They had their big deleveraging event after the GFC. In the US, it's probably highly levered, high yield corporates. In Australia, it's almost certainly households. You know, we have a very healthy sovereign balance sheet, and most corporates are very healthy in terms of their leverage levels as well. So the strain and the limitations to interest rate rises is going to come from households. So how restrictive, we saw on the previous page, and this first chart just looks at the history of RBA cash rate and what's priced into markets at the moment, up around 3.5%, 4%. How restrictive is a 3.5% policy rate? That's the question. You know, will they be able to move rates beyond that? So let's have a look. I mean, the last time we were at 3.5% was 10 years ago, 2012. So we haven't had that for 10 years. For 10 years, new borrowers have experienced nothing except interest rate declines on their mortgage rates. But importantly, two things have changed in 10 years that we have to adjust for if we're just making a historical comparison to how tight it was previously. The first is that chart on the top right. You remember as the RBA cut rates for 10 years, the banks didn't always pass it on. So mortgage rates relative to the cash rate have widened out, and it's to the tune of about 72 basis points, almost 3 25 basis point rate hikes. So a 350 cash rate now, when you compare it back to 2012, is about a 4.25 cash rate for end borrowing rates. You've got to add that 72 basis points back in. The other important thing that's happened is this chart on the bottom left. I'm just charting household debt relative to household income. So households have levered up about 26% over the last 10 years. So those are the two things that are going to constrain households. When you look at the amount of household debt, the amount of income they have to devote to mortgage servicing, those are the two things that drive it. How much debt have they got and what are interest rates? So when you bring that all together in terms of households and the impact of what a 3.5% cash rate looks like now, is the chart on the bottom right. So that green line just shows the percentage of household disposable income that has to be dedicated to debt servicing. And you saw we peaked before the GFC. In the end of the first quarter, we only get this quarterly. We'll have the second quarter data tomorrow, actually. The end of the first quarter, before the hiking cycle started, that got down to 5.2%, so an all-time low because interest rates were so low. If we pull that chart back 10 years to 2012 at a 3.5 cash rate, gets you to that first hashed line, the horizontal hash line. If you add in the 72 basis points that the banks failed to pass on, you get back to that second hash line. If you add in the 26% leverage that households have taken on since the last time interest rates were at that level, you get to the top hash line. So 3.5 to 4% cash rate is going to be about as restrictive as Australian households have experienced, which is really important and is the key driver why we don't think, or we think the RBA is going to struggle to hike beyond what's already priced. You know, this is a household sector that many borrowers have never experienced an increase in their mortgage rate because they've been declining for 10 years. And many borrowers over the past couple of years, I think it changed at the end of last year, but banks were only forced to stress test borrowers to a 2.5% interest rate increase on their mortgage. A lot of them are going to experience a 4% increase in their mortgage in about 6 months. So it's going to be extremely restrictive for households, a very challenging year for households next year, and a key reason why we don't think bond investors are going to lose a lot of money due to interest rate rises from the central bank from here. So let me wrap up and I'll pass over to Hugh. But as I said, so bond markets have already significantly repriced and expect further rapid rises in cash rates up to around 4%. So you shouldn't dismiss the value that's already come into the global bond market. And bond markets represent much more better value now. And certainly at PIMCO, we've been selectively adding global duration interest rate risk now that interest rates have reached these levels. And we're much closer to our longer term structural targets, which is the way we're communicating to our clients to think about it. We're not pounding the table and saying be long bonds and sell your equities, but we're saying if you've been underweight bonds, which most Australian investors have been, now is the time to start moving towards your longer term structural targets. We're absolutely in the final stages of the economic expansion. There's a better than even probability over the next couple of years that we do end up in a recession, and a lot of that is driven by these tight financial conditions and central bank expectations for next year. So it's not an environment where investors should be focusing on reaching for risky assets or reaching for income. You don't have to. You can build resiliency back into portfolios and generate very healthy levels of returns and incomes in areas of the global financial markets where you no longer have to stretch for returns. That period of TINA, or there is no alternative, has passed us, and we're in a period of higher interest rates and higher volatility. So putting this all together, certainly from our perspective, the events of the first half of the year, while challenging, certainly mean that bonds are now in a position, a better position to provide that traditional role for investors of income generation, diversification, and capital preservation. So let me pause there and pass over to Hugh, who's going to lead the panel, I think.
That's right.
Thank you.
Thank you, Adam. Yeah, so you, Holden from PIMCO, if you could make your way up. And also, well, wow, we've got some heavyweights of the industry here. We've got Poole from Oreana, Lukasz to Pourbaix from Lonsec, and Michael Karagianis from JANA.
Which one is it?
Well, thanks, Vinny. Wow. Yes, can everyone hear me? Is that coming through okay? Excellent. Well, yeah, thanks, Vinny, and thanks, Adam, for that presentation. I think it's come through pretty clearly in the first two sessions, even the Australian equity session, as Adam pointed out, that bonds are a very interesting asset class at the moment. That's maybe not a sentence that we've heard a lot over the last decade or so, because investors are trying to weigh up these sort of different variables where we've had obviously a large drawdown in mark-to-market valuations over the first part of this year, but the flip side to that is much higher yields, but still ongoing uncertainty in terms of the macro environment. Does inflation remain elevated? Does it come back down? Do we move into a recession? All of these types of considerations. So what we want to try to do with our esteemed panel members today is talk through, firstly, maybe at a higher level, what did you take from Adam's presentation? Was there anything you'd add to that, challenge, agree with? How are you thinking about things at a higher level? And then we'll look to delve more into some of the details and I guess the specifics around what you guys are doing when you're building multi-asset portfolios and looking at asset allocation, both within fixed interest, but across asset classes. And then we'll also make sure that we leave time for questions from the audience. So guys, if you did have any questions for Adam or that come out as we go through the discussion, please just take a note of them and we'll make sure that we allow that. But I guess just to get the conversation started, first impressions of what Adam said, maybe how you are seeing the fixed interest space at a very high level and its ability to, I guess, generate some of those defence income diversification that Adam talked about, maybe relative to where we were a year ago. And perhaps, Isaac, just because you're sitting next to me, maybe I'll start with you and we can move down and get everyone's initial impressions.
Sure, yeah, thanks, Hugh. I guess the presentation itself, the title was very helpful, saying goodbye to TINA or farewell to TINA. It's been a challenge over the last few years.
Hugh's smiling because he came up with that title.
I did, yeah. Thanks, Laz.
Well done. Yeah. Marketing is working well at PIMCO. Yeah, I mean, it has been a challenge over the last few years to speak to clients and investors about the role of fixed income in portfolios, because the three key roles that you mentioned were challenged. And the slide that stood out for me in a big way alongside this was the forward-looking returns of the 60/40 portfolio. And we're coming through a period through to the end of 2020 where you could go out to conferences like these, not just in Australia, but around the world, and every single multi-asset manager, consultant, worth their salt was saying it's the death of the 60/40. There's no longer a role for fixed income in the portfolios. You've got to push out the risk curve to be able to get your income. Fixed income isn't going to get it done. And that's going to be the new normal, the future of a 60/40 and diversified portfolio. It's done. And I mean, I guess they were probably running victory laps over the first half of this year to some extent, because it did get hammered. It had a really terrible 6-month period, and we've all suffered through that. But of course, now we're having a bit of a reset, and it looks like the 60/40 will deliver on its promise and its goal for a very wide range of investors. The challenge that we're all facing as asset allocators and managers, people who interact with clients, is that the mindset is still not there. There hasn't been a big move on from TINA, and there's a lot of education required in this space, I think particularly on the fixed income side, to get people back to that realisation that you can reduce your risk now, get better returns now, and fixed income is going to be a really critical part of driving that.
Excellent. Well, Adam, I won't ask you to review your own presentation yet. We'll call on you in a minute. But maybe, Lukasz, did you have any initial thoughts or comments?
Yeah, look, I mean, I think at a high level, sort of agreed with a lot of the sentiment. I think, as Isaac said, it's for the first time in a long time where bonds are definitely starting to look interesting. You certainly are getting more reward for the risk you are taking in that asset class. But at the same time, I think it is also an environment where you've got to be very selective in terms of where, bonds is a broad category of assets. You've got bonds and then you've got bonds. We saw high yield markets are very different from, say, where government bonds are today. So I think you've got to be a lot more selective maybe than in the past, but that does create opportunity. And I know from our perspective, the bulk of questions we've been getting from our clients has been about bonds. And I think trying to get that message across, trying to take a forward-looking view on it, because I think there are a lot of clients that are still anchored to the hold zero bonds, sort of, that very binary view of the world. But they are certainly starting to look more attractive than they were. I think one of the interesting things, and probably one of the market's pricing in a certain level of, I guess, rate hikes. But I think on a global level, there are still some X factors out there. We saw overnight Russia cut off some of the gas to Europe. You saw gas prices, I think they went up about 20%. Some of the predictions for inflation in the UK, I think around 15 to 20% inflation. You get these sort of numbers. So I think we're not out of the woods. There are still some potential X factors out there, but certainly the environment for bonds looking forward in terms of the return and the role in a portfolio is a lot better in terms of than it was.
Yeah, excellent. Thanks, Lukasz. And Michael, I guess anything to add at the outset there?
Yeah, look, I mean, I think Adam's encapsulated, I think, a really mainstream view of bonds now becoming more important in portfolios and probably going from, effectively a non-zero asset class in terms of return to something that is meaningful, and therefore we need to take it into account. And certainly that becomes more creative and gives a lot more optionality in terms of portfolio construction. I guess picking up on some of the points that Lukasz made, though, that we do have a fundamental conundrum in that at the moment bonds are offering maybe 3 to 4% returns, and inflation is double that in effect. Something's got to give. So effectively what's happening is that markets are assuming that central banks will get inflation under control and will get it back into the reasonable bounds of normality, in which case you are actually implying a real yield that is positive in the bond market at this point in time. The danger, of course, is they don't, or at least they take so long to achieve that, there's a lot of damage done, so that you could see perhaps an elongated period of inflation remaining at elevated levels, and people beginning to reassess what a fair bond rate is in that regard, and of course then the corollary impact on equity market valuations and so on. So there's a lot of, there's a lot of faith still priced into bond valuations at this point, which make it a very high risk environment. At the same time, of course, we've got central banks that are, have obviously stopped buying bonds, and so we've had a corrupted bond market for many years. I mean, really trying to identify what is fair value for bonds has been quite problematic because central banks have owned a large swathe, if not the majority of it. Now they're actually stepping out of that. And if they accelerate that process, is it unreasonable to think that bond rates could actually rise further in yield in this sort of environment? And I guess then the last point to make in terms of the risks, I mean, that's probably the risk to the upside. In terms of the downside, of course, is that having allowed this environment to get out of control, excessive liquidity, central banks are now really tapping the brakes very, very hard, and markets are giving them a better than even probability of actually getting out of this environment with a soft landing. The danger, of course, is that it's not a soft landing, and we actually do see a much more aggressive slump in economic activity, effectively global recession. And of course, that could be very good for conventional government bonds, but it could be quite catastrophic for credit, of course, with that equity risk premium that's built into credit spread. So, I'd have to say that, while it's certainly a more attractive asset class, it's not without risk. And we do need to be mindful of the fact that at the moment, when you look at it and you look at some of the parameters out there, it's sort of something's not quite right yet. Inflation's got to give, or bond markets have got to give, credit spreads have got to give, or the economic cycle's got to give. It's not quite in equilibrium at this point in time.
Yep, I think the term that we've heard bandied around is there's very fat tails to the distribution at the moment. You sort of just outlined it, Michael, then. There's the upside risks where inflation remains elevated and bond yields do have to rise, but there's the downside risks where we end up with a recession over the fairly short term as well. So I guess that's a good segue then to get into how do we think about this asset class within portfolios. Lukasz made a good point that bonds, I think they often get categorised as just one big sort of umbrella, but there's very different parts of bond markets that we usually would expect to behave differently in different environments, and potentially they have different objectives in a portfolio as well. So a way I thought that we could try to attack this was to work through some of those objectives for bonds that Adam mentioned in his portfolio. So that was income, diversification, defensiveness. Maybe we'll start with income, and it sounds like there's sort of consensus that the income potential for bonds is now much higher than it was, and I guess that's kind of self-evident. Yields are a lot higher, but the risk potentially is there in credit if we were to see spreads widening or things like that. So I'll come back to you again, Isaac, and I'd just be interested in your thoughts. Firstly, around that income potential, how do you weigh that against, I guess, the prospect for recession or downside risks to economic growth? What type of bond strategies would you be looking at if income was the objective? And maybe how do you weigh it up against other asset classes? So say equity dividends, term deposits. So a broad question there, but how do you think about that income piece and what type of strategies would you be looking at if that was an objective?
Yeah, I think Mike and Lukasz kind of hit the nail on the head a little bit there around understanding that not all bonds are created equal, and we have a bit of a tendency in the industry just to call them all defensive, and that hides the fact that, of course, they're not all defensive. Some of them are really focused in on income, high yield, once you go out loans in a rising interest rate environment, floating rate loans, in an inflationary environment, tips. They all have specific roles that you can play within the portfolio, but when you're thinking about income right now, there really is an opportunity to build a diversified income stream that hopefully will be a little bit more resilient to the types of scenarios that both the guys have painted. And I think Adam really pointed this out in his summary that now is the time to be thinking about resilience. Of course, that's got to do with capital preservation and downside protection. But it's true about income. We still want to have a good set of, a good steady income stream, whether the economy is going up or down or recession or otherwise. So we've certainly seen opportunities to be moving down the risk spectrum, if you like, back towards government bonds, adding some of that in there, knowing that while there's some risk there, and Michael, I think, pointed that out, you are getting a pretty good income relative to history at a potentially low risk, given where yields have got to over the last 6 months or so. If you can have that as a core part of the income stream, then yeah, you can start pushing out the investment grade, potentially a high yield. Maybe you're looking overseas at emerging markets, hard and local currency, and adding to your income and the yield of your fixed income sleeve. But we think in this environment, you do want to try and dial that risk down to the extent you can. And risk appetite is going to be really critical here, because I'm sure some of us have clients out there who are pushing well out to private credit, for example, less liquid opportunities. They're not going to be part of every portfolio, but certainly some of the insto clients and larger clients are using those for income as well. And in that case, it's really appropriate to start thinking about government bonds again to balance some of that credit risk out if the environment takes a turn for the worse.
Okay, and so Adam, I might actually get you involved in the conversation here. Just when you're building a fixed interest portfolio from the bottom up, how do you weigh up some of those risks that the guys have alluded to? So obviously wider spreads, higher yields now available on credit instruments, but some uncertainty with the environment moving forward. So how do you look at that when you're building a portfolio? And I guess what are you doing with the portfolios that you're managing?
So I think the first point when people make a mistake when we're looking at bonds, they always think, the alternatives are cash or bonds. And the starting point of it, the initial conditions of someone's portfolio is probably the most important impact when then you start to look at which parts of the bond market I should access to put some defensiveness in or to put some income in. If you're starting in a 100% cash portfolio, then you probably don't want to whack in 30 years of duration. If you're starting in a quite risky portfolio, then you probably do want that defensiveness of longer duration bonds and income. So if you're starting on you're starting from a less risky starting point, then certainly looking at some of the the more credit focused areas of the bond market. If you're starting from a largely equity portfolio, then you probably don't want to compound that equity risk premium in your bond portfolio. You can look for other alternatives. So it really, that starting point of the initial portfolio you're looking at is important. And I always remind people the bond market is, as you say, it's not just the bond market. The bond market's a massive place. It's bigger than Dorset's size of global equity market. You have everything from 3-month government bonds to 50-year, 100-year government bonds, to emerging market debt, to corporates, to structured securities, and everything in between. And so depending on the wealth of income and return opportunities are there. But where you're accessing that, I would say start from what's your current portfolio. That's the most important thing. You can get great healthy, as I said, yield from high quality, largely government bond portfolios. You can get double-digit yield and income from private credit strategies. So it really depends on the starting point of your initial portfolio, I think.
Okay, very good. And then maybe that is a good segue to talk a little bit about diversification. That was the second kind of role of bonds in a portfolio that you mentioned, Adam. And I might start with you, Michael, on this, because you sort of touched on those diverse range of outcomes that we can be thinking about just from an overall portfolio construction perspective. Adam made the point that bonds have not provided a lot of diversification over the last year or so. We've sort of seen bond yields rising as equities have sold off a little bit. But he did also point out that, excuse me, now with higher yields, there's potentially more room for them to fall to generate that diversification, especially if inflation does begin to moderate. So the question to start with for you is, how do you see that? Do you think bonds can play that diversifying role again now in a portfolio? And how important do you think that is, or are there other areas that you're looking to find diversification from?
Yeah, no, fair enough. Hopefully the microphone's still working. So I'd say that the diversification issue for bonds has been problematic for probably a bit longer, but it's moved in and out of focus, and it's probably been significantly affected by central bank action. where they've distorted the bond market, and clearly the drive towards lower and lower yields has been a major factor that has helped propel equity markets to higher and higher levels, that sort of PE effect from discounted cash flows. So having a purer market, I think, does help, and having a market that has a higher base level of yield does help in terms of that diversification argument. We really have had a view going into this period, going back over the last couple of years, as being very short duration. I think, when we talk about bonds, we talked about the different classes of credit and the risk spectrum of bonds, but of course there's duration management as well that's really important in terms of the way you address bonds. And if you've been in a conventional long bond portfolio over the course of the last year, I think Adam showed you're down minus 10%. At one stage you would have been down minus 16%. Not a lot of diversification in that type of structure. But if you'd been in a floating rate structure, of course, it would have been somewhat different, and you would have actually either isolated yourself from the worst effects of those negative returns, or even in some cases gotten positive performance out of that environment. But that is a very unusual situation, and I think as we've seen bond rates rise, our inclination has certainly been to lengthen duration, because we do see that diversification benefit as coming back into play. Certainly in a worst case market environment where we were to get, say, a more severe recessionary outcome, then we would think that bond rates at around 3.5–4% would give you quite a reasonable capital buffer, offsetting the risks that you have in your equity portfolio. I think the challenge is, of course, the other scenario that we were talking about, which is that inflation remains elevated. And I think the chart that you showed, that the distribution scattergram that showed that the really worst environment for bonds and equity markets is where you get that material and elongated uplift in inflation. And if that was to occur, then I think you could see that would still challenge the diversification argument. But barring that sort of outcome, we certainly agree that diversification is, I think, a more relevant consideration, that bonds have a greater role to play in that and have been lengthening duration. Not prepared to go fully long and take on a conventional duration structure within portfolios, but we've made, if you like, baby steps out along the duration curve to reflect what we've seen in market performance.
Yep, okay. So not pounding the table yet, but reducing the underweight, getting back to a more neutral stance. And so, Lukasz, I guess the other question, and we've sort of alluded to this a few times, that bonds tend to all be lumped in together regardless of what your objectives or what you're trying to achieve in a portfolio. So if you are thinking about diversification, what type of bond strategies would you be looking at Lonsec, or would you suggest that investors look at in their portfolios?
So look, I guess in terms of the building blocks at a very high level, we've always sort of looked at it, the three broad components, and sort of say, what's my duration exposure, credit exposure, and then I guess the other one is more your absolute return type exposure. And so we've never been in the camp that you're sort of zero duration and extreme sort of views. I guess on a broad asset class level, yes, we've been underweight, but within that we've been pretty diversified, with a bias probably to shorter duration type assets overall. What we're thinking about at the moment is in terms of that mix, is whether we trim some of that absolute return exposure and allocate some of that towards some of those duration assets. I think in terms of some of the more, I guess, spicier end of the fixed income market, we've tended to sort of never be big proponents of that, and if we have allocated, we've allocated more in that growth part of the portfolio, because those assets are more correlated to certainly to growth assets than they are to fixed income. So I think keeping it pretty simple and relatively diversified still makes sense, and given that we're in a period of there is some variability of outcomes, it's certainly not a clear path. Having a sort of broad spectrum of exposure, but certainly govie bonds do look more attractive, and that's what we're sort of discussing at the moment, I guess, in terms of our investment committee process.
Very good. So we'll now move on, I guess, the third pillar, if you want to call it that, which is the defensiveness or capital preservation that bonds can provide in a portfolio that Adam mentioned. After we finish this part of the discussion, we'll throw it out to the audience for questions as well. So just keep that in mind. If you do have questions, we'll have a chance in a minute. But maybe, Adam, I'll start with you, because the defensiveness question, you talked about what's priced in by the market. You talked about Australia particularly as an example and what those higher interest rates will mean. But then we have heard also, Michael sort of mentioned the risk that maybe inflation remains higher for longer, or inflation expectations begin to increase. So I guess from your perspective, how do you balance those risks when you're building a portfolio, and what, I guess, gives you confidence that inflation will come down, or, do you in fact think that? Does it remain elevated for a while but gradually move down? What's your take on that?
Yeah, so maybe just a couple of, 2 minutes on the view and then how we construct the portfolios. But when you look at why inflation's elevated, you've had a couple of things. You've had the world growing much quicker, demand side, demand rebounding much quicker out of the pandemic than was expected. Demand rebounding much quicker than the supply chains could recalibrate. And then you've had this series of traditional supply shocks, whether it's in food or energy. When you look at what central banks can do, I think there's always a level of interest rates that stop spending and investment. I think we've found on the way down that there's not always a level of interest rates on the downside that encourages it and generates inflation, but there's always a level that stops it. And so when central banks are lifting interest rates, they're focusing on only one aspect, that demand aspect that bounced back much stronger than they expected. And they will get that under control. We just sort of stepped through why in Australia we think it'll be really restrictive for households next year at this interest rate level. That's a level of interest rates that will stop spending. So that demand is what central banks are trying to achieve. Now, the risks around inflation, to me, are the other three things. Really, for inflation to get out of control, you have to imagine supply chains get worse instead of staying the same or getting a little better. Our base case is they slowly improve, but they don't get worse. And then you just stop having this series of traditional supply shocks in food and energy. You don't need oil prices to go from 100 back to 50. You just need to recognise they can only go to 100 once, and they don't keep going, to 150 and 200. Completely out of control of central banks, but that's certainly, in a situation where demand gets under control because of restrictive interest rates. And you take a couple of years to get back to central bank levels of, somewhere closer to 2 to 3% instead of high single digits. So that's certainly our base case, that there is a level of interest rates that'll get demand under control, supply chains stay the same or gradually normalise, and you stop having this sequential supply shock on food and energy. But we recognise that the risk to bonds is that those three things don't normalise, and inflation remains where it is or gets worse, and importantly, it's more around inflation expectations. I think that they will remain anchored just because central banks are being so aggressive, but that's the risk. So in bond markets, when we put it all together, not too dissimilar to what Michael and Lukasz were saying, in PIMCO portfolios, we've been short duration and we're gradually getting closer to target. We're not sitting here pounding the table saying you should be limit long bonds, but you should be at these levels much closer to a structural target and owning more than you did. So maintaining the portfolio, getting closer to target, but a little underweight duration here. And as I said, if you're really worried about inflation in global bond markets, you can buy inflation-protected bonds, as I showed you on the chart, that are pricing inflation at 2.5%. If you think inflation stays at 10, buy them, you'll get paid 10. And so there's plenty of ways, whether it's explicitly owning inflation-protected securities in bond portfolios, which we own some at these levels, or remaining a little short duration and being cautious on the credit side. There are all ways to kind of actively navigate a more persistent level of inflation.
I think one of the interesting, just the points there about the supply chain. So, we've seen some evidence, obviously, that some of those issues are easing. It's still early days. But I think one of the interesting aspects, which I still think is a bit of an unknown, is the structural, inflation, is it going to go back? How far will it go back down, or is it going to be structurally higher? And one of the things about the supply chains, obviously, companies have sort of realised that, anchoring yourself to one sort of structure in terms of supply chain is risky. The whole world's realised that over the last several years. So you are seeing some of those, a reshuffle of supply chains, and it may mean that, the cost of goods just remains elevated because of that. as companies look to shore up those supply chain issues. So there are still sort of some of those things which are a bit unclear, but I think, I think inflation will probably head down, but probably will be more higher than maybe what we expect.
And I think that's a key point. I don't think anyone's suggesting that inflation's going to remain in double digits. I mean, I think your point about oil prices go to $100, they have an immediate impact on headline inflation. They only have to stay at $100 and that washes out. But that ignores second round effects. And it also ignores the fact that there may be, an elevation to the expectation of inflation moving forward. And I think that's the dangerous thing, that the longer a higher inflation environment permeates, the greater the expectation of it being sustained. And we saw that in the 1970s. There were a lot of structural factors that caused inflation to sustain itself through that period. Centralised wage fixing, for example, is one a case of that. But taking up Lukasz's point, I mean, if one of the biggest pulse effects on the global economy in terms of disinflation has been the emergence of China in a globalised environment, what are the effects of a stepping back from that? Is there a danger here that instead of core inflation or a reversion of inflation back to 2 to 2.5%, it reverts back to 3 to 3.5%? And you only need that to say, well, if that's the longer term inflation paradigm we're looking at now, why would I be buying long dated bonds at around that level? There is no real yield in that. So, I think that we could be talking, just 1 to 2% type differentials here that could, mean that we've just got to be careful about what is the level that we have real commitment about investing in bonds.
Yeah, I mean, maybe I'll take add a different perspective, because there is a lot of concern that inflation expectations will ratchet higher and we might be moving to a lengthy secular period where inflation is at the top end or maybe a bit above central bank targets. And there's a lot of discussion out there about what should the central target be. Should we just accept it? It should be 1% higher or so. That's a real challenge. I think there's probably a good scenario to think about where the types of drivers of secular stagnation that PIMCO used to speak about a lot, that were very widely accepted and I think very sensible, debt and demographics being two of those, could severely outweigh the impact of deglobalisation. And I think part of that is showing through in wage growth that is still pretty weak, at least in Australia, relative to where you might have otherwise expected given the inflationary outlook. I think we could be looking at a cyclical bout of inflation that maybe lasts longer than people think about cyclical, 2 years or so. But if we go out 5 years, inflation could actually be at the bottom end of central bank targets. It's not, in my view, a tail scenario at all, and something that is perhaps being under-considered because we're so focused on the higher inflation environment right now.
Maybe a last comment. I mean, certainly we're not expecting inflation to be 2% next year. I think the way you just described it, I think we've come through a period where inflation risks were tilted to the downside because of those structural reasons. We're moving into an environment where inflation risks are more balanced because we now have not everything pushing it to the downside, but we have supply chain issues and resiliency issues that are making that distribution of likely outcomes a little more balanced. But certainly over the next couple of years, we're not expecting inflation or next year to be down at 2%. I think our forecasts are 9 this year, 5 and 3. So a gradual normalisation in interest in inflation rates.
Excellent. Well, we'll pause there maybe and see if there's any questions from the audience about anything that the guys have spoken about or that Adam touched on during his presentation.
Oh, hi. My question, everyone's talking about inflation, but what about the event or the chances of a liquidity event? You see the central bank stepping back. Every developed nation now is running fiscal deficits. What's the possibility of a liquidity event, and what do you think happens then?
It's a good question. I'll jump in and I'll invite the other panellists as well. So one thing that we had a really extreme liquidity event, probably the worst we've had in decades, in the first kind of month of the pandemic. So even things like highly liquid government bonds, which you can usually trade literally billions a year, started to trade by appointment. We couldn't get bids or offers in them. Through the GFC, we had a liquidity event that some of the central bank pipes in terms of providing liquidity to financial markets and banks were put in place. And all of the liquidity tools that central banks created during the pandemic are still there. So yes, while the taps are off now and they're going the other way, the likelihood of a March 2020 liquidity event, I think, is much lower, given they don't have to rebuild them, they have to turn them on. So that's kind of, the March 2020 is the extreme in terms of a liquidity event. That was very extreme. I think the likelihood we get back there is a little lower, given all the central bank tools are in place that they established through that period. I would say, however, less than a liquidity event, but I would say that the likelihood of a large drawdown in financial markets without central banks reacting, and that central bank put being a lot further out of the money, I think is much higher now. And that's because of the inflation dynamic. It's not so much they won't pipe liquidity to banks if they need it, but they certainly won't be turning on sort of government bond programs or anything if inflation's still in those high single digits. So I'm less worried about an extreme liquidity event, but I think you have to be very aware of a potentially larger drawdown in financial markets than you're expecting before central banks come back in and start providing that protection.
Yeah, I think that's a pretty critical point. Sorry. Unbelievable. I did turn it off. One of the concerns I guess you could have is that the financial conditions environment that we have is extremely tight, and it's been one of the tightest we've seen over the last 10 years. You'd have to go back to the GFC, I think. I think you showed a chart showing, apart from that brief period in the aftermath of COVID, which was really related to central banks stepping in so quickly to rectify the situation, you'd have to go back to the GFC to see a liquidity tightening like we're going through at this point in time. The danger of that, of course, is that things start to break. And what you're seeing is a much greater credit tiering in markets. High yield spreads have reacted to it. Emerging market spreads have reacted to it much wider. You see government debt within Europe, for example, now pricing in a closer realisation of potential default risk, with countries like Italy, for example, which a year ago were priced very close to prime grade European debt, now with a massive credit risk and political risk priced into them as well. And it's not unreasonable to expect in this environment, if central banks are true to their word, there will be actually an increase in default. And maybe that's a necessary outworking of this, where central banks were so interested in carrying the global economy forward, they were allowing corporates and governments that really should not have been able to borrow, and certainly not borrow it under the terms that they have been able to borrow at, access markets where the actual risk of them defaulting or them not being able to repay that debt in a more normal environment was quite real. And that is, I think, coming back to the fore now. So you could argue that a lot more is priced into the markets at this point in time. That's good news. But the danger is that we do actually see a significant acceleration in default risk moving forward.
Mm-hmm. Was there another question I think I saw there somewhere or heard?
Yeah, I could ask quite a few questions to the panel, but I just want to ask about the Job Summit, because no one's mentioned that today. What's the risk from sector-wide bargaining, and will skilled immigration help to dampen that a bit?
I could jump in and have a couple of comments. Australia's got a little bit of a unique wage setting process, which is why we're seeing we're taking a while for wages to tick back up. I think a quarter to a third of people on a minimum type wage, a quarter to a third on enterprise bargaining, and it's really the remainder that are kind of resetting a little bit more real time. So I think that has been a slower reset. To the extent that we come, I don't know how powerful this Job Summit's going to be. I don't have a really strong view on that. But I think that certainly the risk, I think, to risk to financial markets and asset returns are inflation expectations, which get embedded into wages, and a collective strength of agreement starts to sort of ratchet that higher. I think that's a real risk, and Michael mentioned it's one of the reasons we had issues in the 70s with inflation that wouldn't come back down. So I see it as a tail risk. I don't see it as kind of a baseline view that through the strengthening of collective bargainings, we get into a kind of wage price spiral that we saw in the 70s. It's a tail risk, but I don't hold it as a base view.
Yep.
Sorry, just a quick question just on geopolitical tensions. So this is all assuming a relatively normal environment. What happens if the geopolitical tensions exacerbate and spread, and how does that impact not just bonds but portfolios in general?
I think we might all have a go at this one. So obviously the epicenter of geopolitical tension at the moment is Russia. And the most visible impact of that is on energy prices, which of course is most painfully being experienced by Europe. But of course we've seen the energy complex generally rising, and that's one of the driving forces of inflation, at least in the first round. But probably the greater longer term danger is a geopolitical issue relating to China because of its interlinkage into the global supply networks. And while we're in transition perhaps, we are so dependent on China for a huge range of goods that they are the focal point of supply chains. So that would be the absolute critical issue, I think, that would be very difficult for markets to adjust to, inside of several years. I think that would be a structural shift in terms of the way markets would have to think about inflation, would have to think about political risk factoring into market valuations.
Yeah, I mean, I think you're absolutely right. So if that scenario panned out, Taiwan gets invaded, whatever it is, but that would have a much broader impact. There's sort of one of the arguments that, what's sort of one of the arguments against that happening is that, in a way, for China to maintain stability within China, they have to deliver a certain amount of growth, economic growth. While they are delivering that growth, sort of things travel as they travel on. If that growth, for whatever reason, if it's a conflict, you've seen obviously sanctions on Russia. I mean, China's watching all this as well. So there's a lot of argument with say it's not in their interest to go down that path as well. So look, these are hard things to sort of predict, but you sort of try to sort of work, what are the possible scenarios? But I think, if the worst case scenario, then I think it's all bets are off and there's nowhere to hide really.
Guys, I can see the clock is in the red numbers there, 46 seconds left. So very, very quickly, Vinny, I just want to go across the group in like 2 sentences. What are you doing with your fixed interest portfolios? Maybe in terms of duration, credit, has it changed? Isaac, I'll start with you.
Yeah, we've moved to neutral on our strategic weights for duration, and we've shifted our credit quality up towards investment grade.
Not too dissimilar, actually. So adding some duration into portfolios, getting closer to long-term structural targets. Being very focused on opportunities in the global credit market, but selectively. Making sure as we pivot into a year next year that is, recession risks are heightened. They're in the high quality, more resilient end of the capital structure.
1 second left.
Oh, sorry, Michael.
So still slightly underweight, broadly fixed income, but we are having that discussion at the moment in terms of duration.
What he said. We're probably about 60% of the way along the duration curve now, having been a lot shorter than that. We'll keep monitoring it, but probably want to see a bit more uplift in yields before going a bit further yet. But have certainly looked to maintain exposure to absolute return type strategies where the managers have got a lot of flexibility in their duration management and their credit management. I think that's still a worthwhile part in a portfolio.
Excellent, thank you. Vinny.
Thanks a lot. You, Isaac, Lukasz, Michael, Adam, thank you so much. Please join me in thanking you.